Welcome back to the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Georgella.
My name is Philip Tributowski.
And I'm James Sivko.
We are absolutely loaded. We are to the brim here for May's episode of the Automotive Market Minute. It's more than we could even put on the agenda here. FF dealer performance. What the hell? Used cars. Retail gas prices. We all know everybody's thinking about that. Consumer spending is hot. We promise. Tax returns, negative equity, and there's a bunch of stuff in between there we couldn't even put on the agenda. If you enjoyed this video, hit subscribe. It's free, and we want to make more videos that you love for people just like you. Thanks for the support. So, the month of April, first and foremost, we heard it was profitable for many dealers, quite profitable. So that's great to hear. Used sales down month over month. There's a lot of red here, but let's not be alarmed. A lot of red here. Traffic a little bit off, leads a little bit off. Now, remember, we had one less day in the month. That matters. One less day. Tilt the scales a little bit here. Soft on appointments, new sales a little bit off, used sales. But something we'll be talking about multiple times. Used sales actually up year over year. I'm going to talk about what I believe to be a market floor. And I believe that used sales will continue to look that way in the coming months. So a little bit of a market floor, but there is something really odd going on with used vehicles.
It's a little bit of a lagging data set here, but if you look at March, we're coming off a print of 1.95 million used vehicles on dealer lots. That is the lowest number on record dating back to 2019. It's down about 6% compared to a year ago. However, we did see a very strong used sales volume in the month of March, but like Steve just mentioned, a little bit softer in the month of April. And we're seeing something very interesting start to hit the used car market. We're hearing about a split velocity market. So what does that mean for the industry?
There are less vehicles available, but they're sitting longer. And I know what you're probably thinking, Steven, what specific vehicles are sitting longer? Well, let me tell you. If you got a luxury used vehicle, it's probably overpriced and sitting. If you have an EV that is aging, it's probably sitting. If it's a newer model, it's probably flying off the shelf. Late model used cars flying off the shelves. If you have a used truck that's inevitably going to get a very high interest rate, that is also sitting. I think approximately 70 days is what I saw. So this split velocity market is not something that I'm really familiar with. We actually sat during our prep time here at the Automotive Market Minute, and I said, James, this doesn't make sense. If there's less vehicles, then they move quicker, et cetera. And James goes, listen, Steven, I don't bring you data that's not legit. Okay. He goes, I need you to open up your mind to what's happening here. And what's happening here is there's just certain vehicles that are not fitting the consumer's eye right now, and they're sitting. And I hear from dealers that they're sitting when they're like, this vehicle's been on my lot for 65 days. I can't figure out why. Well, we know what they are. They're used luxury vehicles. They're expensive used trucks. They're old EVs that are all loaded and they don't know how long the battery's going to last, et cetera. So that is what's currently happening in the used car market.
Split velocity market.
This will be a developing story over the summer. It doesn't matter whether we get resolution to the Strait of Hormuz situation. These are gasoline inventories in the US. This is in millions of barrels. The blue line is where we are now, and the shaded gray area is where we've been over the last 5 years. No matter what happens, we are going to deplete our national inventories of motor fuels, and the price of gas is just going to go up. And we should expect it, no matter what happens, to be elevated really for the next 6 months. So all the way to the holidays, we are going to have elevated gas prices. If this trend continues even a little bit, and we think it's unavoidable, then expect to see 5-year highs in gas prices, which we have a chart of right here for you. So get prepared to maybe have consumers be paying $1, $1.50 a gallon more than where we are now. In some states, that'll be over $6 at the pump. This is a national average of all formulations from premium all the way down to regular. Now, this is not as important as it used to be. Back in the 70s, we were spending maybe over 5% of our consumer spending on energy. Now it's really only 3 or 4% is on energy, and some of that's heating the house and stuff like that. So gasoline expenditures are even smaller. The consumer is really hot right now. So this is a bunch of consumers that have been doing great and that have been able to take the increase so far in gas prices in stride. Take a look at this. This chart is year over year consumer spending. There was such a movement in COVID. We actually cut off COVID on purpose. So you can see consumer spending here over the expansion since 2008. It's been just under 5%. And now it's jumped to pretty comfortably over 5%. That's incredible consumer growth. And yeah, some of that's inflation. Some of that is at the gas pump, or some of that is in things like car insurance that are very inflationary inputs right now. But the consumer's been taking it in stride. And we'll get into this later in the market minute, but this is being powered by an excellent labor market. So your consumers that are coming in the door have the capacity to be able to spend on autos.
Switching gears into incentives, you can see kind of over the last recent number of months, actually really recent number of years, incentives have kind of been ebbing and flowing. March incentives rose to 7.2% of the average transaction price. That's up from 7.1% a year earlier, and it's up compared to February, which came in at 6.9%. Incentive spending has increased for consecutive months now, but we are not seeing the average incentive be at historical levels. You can see after coming out of COVID, incentives really kind of fell down to pretty much negligible. There weren't any incentives coming out of COVID in a low interest rate environment. But as interest rates have increased over the recent years, incentives have as well. But again, they're not quite to the same level that they have been at historically.
The chart on the left, this is very noisy data. This is the weekly claim number. These are people newly unemployed. And take a look at the drop that we just saw. Now, again, it's a very noisy data series. You've got 50 states trying to get their reports in on time. And sometimes in Sacramento or other state capitals, they screw up the one job that they have. But this is a 40-year low for people entering the unemployment rolls. That's the graph on the left. The graph on the right is more meaningful. It's also full of some noise, but man, this is such a great trend. This is continuing jobless claims, and this has become an ever shrinking number. So the chart on the left is the entry to the unemployment rolls, and the chart on the right is the number of people that are on the unemployment rolls, and the labor market is tightening and consumers are doing great. And this is what is fueling the great consumer spending that we've been seeing over the last several months.
We've been talking about tax returns a lot. How is this year shaping up?
We have really high hopes for 2026. The whole first half of tax return season, it was about an 8 out of 10 in terms of being the 8th best out of the last 10 years. And 2 of those years were kind of boosted by COVID. It's fallen behind a little bit. The checks are still bigger than we've ever seen before. 15% bigger than the last 10-year average. It's kind of what the administration has promised us, but the pace here has been kind of slow. So folks have either been filing extensions or waiting to file or taking their time to get their tax returns, or the government's been taking their time sending them out. So we are a little behind, and this is a kind of a recent development here over the last month and a half, where we started to kind of fall behind a little bit. No matter what happens, we do know what's baked in the cake, and that is over the next 30 days, you're going to see an additional $50 billion worth of checks. And those consumers are more likely to buy cars in the next 3 weeks after they get a check. And this next graph is really interesting from Bank of America. And this is just the tax return effect on all kinds of spending. But right there, the next to the last column on the right, columns that is, the consumer spending is 20% higher the 3 weeks after you get a tax check as a consumer than it is the other 29 weeks of the year. So there's a ton of households who still have to get their checks over the next 30 days as we close down tax return season. There still is $50 billion out there, and it's our job to go get it and put them in some cars.
We've been talking about negative equity a lot. Steve, close us out here. What are we looking at here?
Negative equity, the thing in which dealers bring up on a day-to-day basis, get a lot of leads over the weekend, things are exciting, and then all of a sudden, after you set 7 appointments and it's wonderful, 6 of them showed up, you find out that every single one of them is back an average of $7,200. That leads me directly into my closing monologue, and it's a doozy. To wrap things up for this May update, I want to settle a debate that's likely happening in your sales tower as we speak. You're looking at the national news and hearing that used car inventory is at a 4-year low. You might look at your lot and think that you have a supply problem. But then you look at the raw data and it shows days in the market, 5 to 53 days. So how can we have the fewest cars in years, but they're taking the longest time to sell? This is where we have to get forensic. The truth is, we're in a velocity trap. We have an undersupplied market meeting an underdemanded market. Even though used sales are technically up 2.5% year over year, the pace has slowed down significantly. And here's the kicker for your buyers. Auction prices are not giving you any relief. Wholesale prices have been on a vertical climb all year, and the dealers are calling me on a regular basis saying, Steven, I can't pay $3,000 over book. I can't pay $2,000 over book. I've got to find a way to get some more used vehicles. You're paying a massive premium at the lanes today for a car that's going to sit on your lot for probably 2 months. And I talked about it earlier. If it's used luxury vehicles or if it's used high-priced trucks, from an appraisal standpoint, you have to be aggressive, but you also should expect that those high-priced used trucks are going to have high interest rates. So it'll be difficult for the consumer to be able to afford those. Between $4 gas and record negative equity of $7,200, the picky buyer, in my opinion, has officially arrived. They have some cash from the tax returns we're talking about. We know the tax man is still sending about $50 billion this month, but they're terrified of one key thing, and that's the monthly payment. Rightfully so. My challenge to you this month is to stop treating your used inventory like a static asset. If a unit has been sitting for 53 days, it's not just inventory, it's now a liability. We are seeing a massive divide. The affordable units are still turning, and the stale units are dragging averages through the dirt. You need to go all in on acquiring used vehicles off the street. Deploy as many resources as possible. Don't let a low volume market trick you into being lazy with your pricing or your appraisals. Your customers are complaining while buying, as Mr. James Sifko has said multiple times. They want to move, but they need you to solve the math of their underwater trade. Use that remaining tax liquidity to bridge that gap and move your aging inventory before gas prices hit $5 and sentiment truly breaks, which it very well could. The units are few, but the days are long. It's time to take your inventory mastery as seriously as ever. On behalf of my esteemed colleagues, Mr. James Sifko and Phil Trebetowski, my name is Steven Georgella. I have no clue what's going on in the world, but God willing, we will be here for another Automotive Market Minute next month.